Good morning, everyone. Thank you very much, Leland, for inviting me to be part of the convening institutions that have been organizing this amazing event. I'm really honored to be here. Thank you also to Wanjie Ching and to Tatiana Karayanis for thinking of me to be part of this conference. I'm going to lead the first panel that is really important. It's about trade, investment, and finance. We all know that the similarities between China and Africa, or the similarities between the Chinese interests in Africa and Latin America and the Caribbean are reflected in the growth and the structure of their economic relations with China. First, both regions, of course, have seen a rapid, my colleagues have just said, have seen a rapid expansion in terms of economic relations with China and, of course, other types of relations. This panel, of course, is going to deep into not only the bilateral trade, that means bilateral trade, but also the investment and finance that China has been providing to countries in Africa and countries in Latin America and the Caribbean. These trends and these economic links have grown massively in both regions since the turn of this century. And natural resources, of course, play a central role in the economic relationship between China and countries in the global south, particularly in Latin America and particularly in Africa. Primary products and resource-based manufacturers make up, of course, the bulk of China's imports from both regions. Energy, including oil and gas, and metals, of course, mainly mining, account for around 3/4 of China's FDI in both African and Latin American countries. And China has also made numerous loans in countries in both regions, which are repaid through sales of commodities, particularly oil. This has been an extremely important case, for example, in cases in countries like Ecuador and Venezuela in Latin America. And Africa and also Latin American countries, imports from China are almost, and we all know this, entirely manufactured products from China. In both regions, of course, the dependence of countries on exports of certain products like oil, copper, and iron ore to China have increased in recent years. So although these are some similarities that we can see in the relations, economic relations between China and countries in Africa and Latin American countries, there are also some similarities that we can, some differences that we can find. And these are, of course, important economic, but also political and institutional differences between the two regions. So this is what we are going to talk about in this panel. I'm really honored to have Hannah trying to deep into the relation between China, the economic relation between China and Africa, and of course, Victoria Ching and Gerard Johnson and Osvaldo Rosales talking about more about the relationship between China and countries in Latin America. So I'm going to introduce these four experts that I'm really honored to moderate today. First of all, we are going to listen to Hannah Ryder. She's the former diplomat of economic. Is a former diplomat and economic with 20 years of experience. She has participated in projects in China, Ethiopia, Rwanda, Nigeria, Indonesia, and Korea. She was named one of the 100 most influential Africans in 2021. She's currently the CEO of the development Reimagined, and she is also a senior associate for the Africa program of Center for the Strategic International Studies and sits on the board of the Environment Defense Fund. Thank you very much, Hannah, for being with us. She is going to participate online. Thank you also, Victoria, for being with us today. Victoria Ching holds a PhD in political science and international relations and a master in economics from the University of Southern California. She is currently a postdoctoral scholar and also a teaching fellow at the Department of Political Science and International Relations at the USC. She is an expert in China's politics and foreign economic policy, particularly in the Latin American, China, and US relations. And we also have the honor to have here Gerard Johnson. He's an economics, he's an economist with extensive experience in economic development in the Latin American and the Caribbean region. He is currently the senior advisor for CIAF, particularly in the Caribbean initiatives. He also served as a senior policy advisor to the Minister of the Finance and Public Service in Jamaica, and as the former general manager of the Caribbean Country Department at the Inter-American Development Bank. And lastly, but not least, we also have here Osvaldo Rosales. I'm really honored to be moderating this panel, and I really admire him. Osvaldo Rosales is a Chilean economist and independent consultant. He is the former director of the International Trade and International Division at the United Nations Economic Commission on Latin America and the Caribbean, that is ECLAC, or CEPAL for those that come from Latin America. Between 2000 and 2004, he was also the Director General of the International Economic Relations of the Ministry of the Foreign Affairs of Chile. He led negotiations for Chile's free trade agreements with many countries, particularly with the United States, Korea, and the European Free Trade Association. And among others as well, he participated in the preliminary negotiations for Chile and China free trade agreement. So first of all, I want to just ask this panel a bunch of questions and then move to another round of questions. The first round of questions is to give the word first to Anna, and then to Victoria, and then Gerard and Osvaldo, and ask them about the recent trends and challenges and opportunities of China's economic engagement with countries both in Africa and Latin America and the Caribbean. What do you see that are the main challenges of economic development for these countries, and how these challenges can be addressed? So please, Hannah, if you can start.
Yeah, thank you so much for the opportunity to join today. I hope you can hear me okay.
Yes.
Yeah, okay, great. So thank you very much again. It's wonderful to be joining you. I'm at the IMF World Bank annual meetings in Marrakesh, so that's why I'm not with you in person. But nevertheless, I'm glad for the flexibility to be able to contribute. So to really kick off, I will really I want to leave you with three key messages. Number one, that there is no one African story or experience of China, and I think the most recent trends illustrate this. Number two, that the challenges have been around for a long time and still and continue, but the opportunities, and the third one is that the opportunities are increasing but also changing. So I think the information that I will share today, I hope illustrates this well. Just in terms of the very recent trends, let me just very quickly begin with the political, because I think because the China-Africa relationship especially is really determined through government-to-government relations, tracking the political sets the agenda for understanding the economic cooperation. Since the last FOCAC, which was in 2021, and obviously that was during the pandemic, there have been 18 visits of African leaders to China, and that's leaders from president to the prime minister to foreign minister. And there's going to be more expected for next week's Belt and Road Initiative. There's also been increasing collaboration with the African Union, who have a representative office in China, have done since 2018. And so that is also driving more political cooperation. And it's also worth noting that there was a special dialogue on the sidelines of the BRICS summit between China and some African countries, hosted by China and South Africa, and that there were 3 initiatives that are announced on industrialization, agriculture, modernization, and also talent development. So that is going to be really interesting to follow going forward, and will determine some of the newer trends we might see over the next year as the next FOCAC is being prepared, and that will be coming up in 2024. But underlying all of that, as I said, the political quite often determines some of the economic. And despite the pandemic, in 3 areas there's been shifts. So in trade, for example, over the last 2 years, it has been diversifying and still increasing between China and Africa. And it does mean China is the 2nd largest export destination for African countries. Trade with China is still highly, as was mentioned earlier, it is still in a deficit. And in addition, 60% of the trade is dominated by commodities. But at the same time, it's diversifying, and especially through market access initiatives. There's been a really large number of market access initiatives that have been announced, especially on agricultural products, and that has made quite a difference. And from countries from Benin to Tanzania, and at the same time, this trade is still highly concentrated. So 10 countries account for over 80% of trade with China. So that's why there's no one African story, because each country has some specificities. Lending and the financial aspect is obviously very important in the relationship, and that has been continuing, albeit at a slower pace, and especially because of COVID. Over the last 2 years, there were 16 new contracts, according to data which was collected by Boston, the Global GDP Center in Boston, worth 2.2 billion USD. The largest of those was Benin. But it's important to remember that if you are looking at this from an African perspective, rather than just overall, if you break it down to many countries, the pace of Chinese lending has always been fairly uneven. And so there's some African countries that haven't been lent to for years, or have not sought lending from China for years. But others, of course, that have managed to more successfully more recently. So there's questions around kind of demand and supply for all of that, but and that determines what one might think about the future. Is this a demand question or a supply question? I know it was raised earlier about is China's economy going to shift, but create shifts in lending. But it's interesting to know that lending has still continued. And some of it is especially connectivity-based infrastructure, transport projects in particular, also digital. And there is also more interest in public-private partnerships. And that's the segue into the final area that I want to just mention, which is investment. And investment, so foreign direct investment specifically, which we really have to distinguish from lending. Foreign direct investment has also been increasing, although it did decrease over the COVID period. So stocks, foreign direct investment stocks are almost back to pre-COVID levels for China on the African continent. And that means that China is the continent's 5th largest foreign direct investor after US in 4th place. And 10 countries account for around 65% or around 65% of the foreign direct investment, but they're not all, the usual suspects from other foreign direct investors. So, again, countries like Tanzania, Ethiopia, middle-income countries and low-income countries are destinations for Chinese investment. And though it was mentioned, yes, around 23% of Chinese investment has gone into mining in terms of the stocks. So much of it is actually construction. So 37% is construction. Again, that distinguishes China, and that trend continues to be the case. The mining is a smaller proportion of investment compared to other foreign direct investors. And a final note that the share of manufacturing remains fairly smaller, around 14%. But again, with the initiative that has just been announced, we can likely expect that the share of manufacturing in Chinese foreign direct investment will increase and value addition will increase. And we've seen certain new agreements in relation to that as well. So I think in terms of the challenges in terms of, for most African countries in kind of working out how much lending and borrowing to do from China continues, especially to stimulate growth in infrastructure. Those challenges still remain, and but there's still openings for African countries to do that and to use those finances in as productive a possible way as possible, so that it stimulates growth. And that's still something that African countries need to work on. The diversification, I would say, of trade also remains a major priority, and the push for balancing the trade as well as diversifying foreign direct investment, pushing it into manufacturing. Again, these are challenges, as I said, that have existed for a long time. But as I said, finally, the opportunities, I would say, are really in the foreign direct investment, in that diversification of trade, but in ways that really ensure that there is really strong value addition from African countries. And the openness to looking at industrialization, of course, is important, and that should make a difference. So I will leave it there and look forward to questions and reflections from others as well.
Thank you, Hannah. Victoria, the floor is yours.
Thank you. First of all, thank you, Leland, and everyone else who organized it. This is amazing, and I feel honored to be here, especially with such eminences like Osvaldo and Gerard. So this is me fangirling. And as he said, as Leland said, this is more about learning. So I am going to talk a little bit about China, Latin America, and I don't want to go too much into the details of trade and investment, because I think that Osvaldo, he will give you a little bit more. But just really general brushstrokes that we could probably discuss a little bit more later on or during the Q&A. In terms of trend, I think that's something that we have seen in Latin America, and similar to what Hannah just said about Africa, right? There's no one single Latin America and the Caribbean. It is a heterogeneous country. We have different trends with each country, depending on their interests, depending on the challenges, depending on the needs, etc., etc. However, in general, what we can see is that for the last 20 years, and I don't think that we're going to see a sudden shift, is that a lot of the commercial and finance and investments, right, are based on commodities, are based on natural resources. That's not something that's going to change, simply because the natural endowment the region, right, is known for its natural endowment. So I think the question is more about how the region will negotiate, or each country will negotiate in how all these different exchanges happen with the Chinese counterpart. That's more in terms of trend. Something though that is shifting a little bit, right? Even though I just mentioned commodities and natural resources, and that's actually more aligned to China's needs. On the one hand, we see an increase in critical minerals, lithium especially, right, when it comes to the lithium triangle. So that's something that we're gonna see not only just from China, but also from the United States and Canada and Australia. So it is something that the region has to think about, not only in terms of China, but also its other partners. Another thing that we are seeing a lot is renewable energy, right? And of course, tied to that, electric vehicles. Although the market's still relatively small, we see an increase of Chinese corporations or companies getting into the region, particularly Brazil, for instance, Argentina, right, to work more hand in hand with lithium and energy vehicles. That's more towards the trend. And like I said, I lead that to Osvaldo. Perhaps he's gonna talk more a little bit about that, but I did want to mention about the challenges, simply because I think that I invite everyone, myself included, and I'm hoping to learn from you, is that when we're thinking about the challenges, I perhaps think of it in 3 areas. The first one is polarization, increased polarization in the region, right? We have seen recent elections. We have seen that our region, Latin America, has been struggling and has struggled for decades, right, in terms of domestic stability, political stability. And now, in the last 5 years or so, we see not only just political instability or the challenge of trying to balance that, but we also see increased polarization. And that goes hand in hand with having weaker states, perhaps corruption, right? So those are things that are more particular on the domestic front, and that's gonna be challenging, not only in terms of interacting with China, but also with other countries, simply because if you do not have stability, right, the policies change constantly, right? And investors need stability, need consistency. So that's something that we have struggled. I don't have the answer, and hopefully we can learn from each other or hear from each other in that regard. Tied with that, I think that for 20 years or so, since China started entering Latin America full force since 2000s, right? It has always been the conversation of what China can offer, what opportunities, right, we have. And I think that continues to be the case, but it has shifted a little bit, perhaps for the Latin American countries. Why do I say that? Because it's not only about what China can offer, it's also how it is offering it. Right? And I think for many countries in the region, now the challenge and the conversation is, how can we negotiate with China, meaning not only the state-owned enterprises, not only with the different firms that could be private at the same time, but also with the state, and a lot of that go hand in hand. And I say that because a lot of times when we think about China itself, when it comes to the region, we're used to think about, okay, the Chinese state-owned enterprises, but something that we forget is that many of these state-owned enterprises are also tied to the provinces. So it's not only about Chinese interests coming in, what they can offer, what opportunities they're looking for, but it's also what the provinces are looking for, right? We as a region, I think we need to be more aware of the different actors on the Chinese side, right, that are coming in and how we can negotiate better, but also from our side, and I say our because I am Peruvian actually, right? When we're thinking about negotiation, who are the actors also on our side? I think that some of the challenges that we have seen, that I have seen in my research at least, right, is that we only think about at the top level in most cases, but I think more and more there is the reflection on agency. And what I mean with agency is not only what the state negotiates, but also the local government, civil society, and the different communities that are involved, particularly when we're thinking about extraction, when we're thinking about minerals, when we're thinking about mining mostly, right? Similar to what Hannah was mentioning in Africa. So these are challenges that we need to figure out, or how to balance that. And with that, I think I'm gonna go to my last point, which is, and was having this conversation earlier with some of my colleagues over here. We are a region that has struggled for 20 years in stabilizing the domestic arena, right? In stabilizing our politics, our economics, and we achieved that to a certain degrees, in diverse degrees, but we have achieved that to a certain extent. Now the challenge is that as we are also continuing to balance those domestic issues, we are also balancing our global integration, right? So how do we balance these two fronts as we are also facing a country that is coming with all its economic and financial and investment capacities, and not only that, we also have a global environment that is shifting really quick. So it's not just United States and China competition. We are also seeing more involvement from other regions, such as the European Union, right? And even Asia itself, we see an increase of countries like Japan, countries like South Korea, that although are not coming with the same capacity as China, they are also coming to try to negotiate. And I know that this is more about China and Latin America and Caribbean as well, and also China, Africa, but I wanted to give a little bit more of this global perspective, because while we want to focus and bring nuance, as Leland said, we also need to bring into conversation all these different actors that in one way or another is still influence the relationship. And I think those are things that are worth thinking about. So I'm looking forward to the rest of the panel, the comments that everyone has, and your Q&A too. Thank you.
Thank you, Victoria. Gerard, the floor is yours.
Thank you very much. I would like to echo your sentiments, Victoria. Honored to be here. First of all, though, this shouldn't say Inter-American Development Bank. I love the bank, but I'm not there anymore. I was a former general manager. The comments I would like to make very quickly have to do with the development model that China is using in the Caribbean. And I'm happy you made a space for the Caribbean, because normally when you talk about Latin America, the Caribbean is a rounding error, and when you talk about mega economies like Brazil, Mexico, then you'd have a country like St. Kitts, where the population is smaller than the student body of this university. So it's good to be here. Despite the small size of the Caribbean countries, where the names of the countries cannot fit, and if you look at the map, they have to be written in the ocean. It's called sometimes considered the United States' third border. So I think location, in real estate, is location, location, location. Well, in this case, I think that despite the small size of the Caribbean countries, the location makes them of strategic importance. The development model that is used, the development finance model, basically there are two windows. One is debt, and the other one is equity. So on one side, which is the debt side, it's concessional finance. It's not as cheap as the World Bank, but it's cheaper than Citibank. So it's concessional because it's less than what the private lenders would charge. The thing that sets it apart for governments who want to finance development projects, why would a government borrow at concessional rates that are higher than the World Bank and the Inter-American Development Bank? But these are not irrational people, so there's a logic. The reason is because there was a model that the World Bank and IDB used to, when they first were created, that was applied. It was what we called it, the IDB was Banco Amigo, where when a country is in trouble and when debt is high, there's instability, as Victoria spoke about, the banks would nevertheless invest in projects that would develop, that would generate growth. That isn't the case now. These institutions, the IMF, World Bank, IDB, others, over the years, the importance of balancing books, the importance of restoring stability has taken precedence over growing out of problems. So the Chinese development finance, what it offers is, in the midst of crippling debt, in the midst of macroeconomic instability, it will finance projects that, although there's money available from the World Bank, theoretically it's not available until the books are balanced. So it's a logical thing for governments to do. In addition, the Chinese development finance accepts local safeguards. What does that mean? That means things like environmental safeguards, procurement procedures, and other local governance institutional requirements. They are accepted, while for the development banks, incremental conditions are required. In addition, the finance comes with its own construction companies. So you don't just get finance, you also get a company that will design the project, implement the project, and hand it over, turnkey. That model is, of course, what people call tied aid, which is nothing new. It's not a new model. It's something that the United States itself used to use decades ago, which would be to provide the financing and the contractors to do it. But that's not the case anymore. After the Venezuelan Petrocaribe program ended, China's bilateral program in the Caribbean is the single most important source of bilateral development finance for the Caribbean. The United States, Europe, mostly depend on their influence in places like the Inter-American Development Bank, the World Bank, and the IMF to influence the policy choices in the Caribbean, and I would say not just the Caribbean. To the extent that bilateral finance from China is preferred over finance from these institutions, the importance of that influence is diluted. Some of the downsides to the Chinese development model in the Caribbean include the following. Governance reforms, which is like, for example, in roads, where a country would put in place a transparent process for identifying which roads to build first, which ones to maintain, establishing a financing mechanism for that construction and for that maintenance. That's replaced with a turnkey project where a road can be built very quickly, and sometimes outside of the transparent choice of or setting of priorities for which projects should be done and which projects are the most viable. Also, to the extent that local safeguards are accepted without question, can work, but also it may not work. If those safeguards are weak, if they are incomplete, if the oversight to make sure that the safeguards are applied are not robust, then to accept them without question introduces the risk of environmental damage, of social problems, and of financing projects that are not viable. The equipment that is brought in, the construction equipment that is brought in duty-free by the Chinese contractors, often remains in the country and is used to compete against local contractors who do have to pay duty to bring in their equipment. So it's not a level playing field. The same is said about the workers who are brought in at all levels, skilled, unskilled, who don't leave at the end of the project, and they once again can have been, it is claimed, deployed for other projects that also compete with the private sector. Very quickly, the other model is equity. The Chinese government will also invest not lend, but actually invest in projects, in mining, in highways, etc., where the asset actually belongs to the Chinese government, it's not a loan. In those cases, there are not that many mega projects in the Caribbean. So if there are projects, this small pool of large projects that could potentially be financed by private investors, by FDI. If they're crowded out by the Chinese government, well then that's a model that the World Bank, if you hear in their deliberations in Marrakesh, and it's a general theme to rely on the private sector to boost growth. Well, then that could be crowded out by that model. When countries get into trouble and they cannot pay their debts, that's when the IMF comes in, when they don't have enough foreign exchange to balance their current account. That's where the IMF comes in with a program to help to stabilize the fiscal accounts. In other words, the government spending too much, can't pay its debt, to try and correct that. What does that involve? It often involves a haircut. It involves restructuring debt. In order for these restructurings to be successful, almost all creditors have to participate. In other words, if there's a holdout and everybody else is taking a haircut, in other words, reducing what they will require in terms of repayment, but there's a holdout who doesn't reduce it, so the government's ability to repay is restored. Most creditors have taken a haircut, but there's a holdout. The holdout is a free rider who benefits from that. Suriname is a good case in point where China is a holdout and where China will refinance its debt, but it's so far been reluctant to participate in debt restructuring. That's important because this is now the IMF. The IMF has the lead. It's the world's banker. If you're in distress, that's where you go. And if its ability to structure programs is hampered by holdouts, and if the holdout is a very large one, in the case of Suriname, you're talking about over 20% of the debt is held by China, then it delays those programs, and it also makes groupings like the Paris Club, which is basically where bilateral debt is renegotiated, it makes them inefficient and not useful. I'll close by saying that we were asked to talk about climate change. We were asked to talk about the role of China in that in the Caribbean. I think it's well known that Chinese solar systems are the most prolific in the world, and it's no different in the Caribbean. So that transition from volatile prices for hydrocarbons, high cost of hydrocarbons in the Caribbean, the cost of energy can be 4 times. So I think in Miami, a kilowatt hour is 9 cents. It's not unusual in the Caribbean to find 35 cents. 40 cents for a kilowatt hour. So if you talk about living standards, you talk about the ability to compete, of course that compromises if you're paying 4 or 5 times the cost of energy in other markets. So that transition is urgent. The use of forced labor, the UN has concluded that some Chinese producers of solar panels and solar systems use forced labor. The US and the UK have, governments have been finding ways to restrict the importation of those systems. The problem if you're in the Caribbean and you are a small company or a household that wants to put a solar system on your roof, and believe me, in the Caribbean, we are very sensitive to the issue of slavery and forced labor, and we do not want to participate in it or to support it or to buy from any company that is tainted by it. But how, if you're a small company, do you know if a company that you're importing from uses forced labor? It's impossible. The resources are not there so therefore who do you rely on? You rely on the UK government or the US government The problem is that those governments are not providing data that would enable small countries, small companies, households to make transparent decisions, because believe me, we don't want to get involved in that. But it would be very useful to share that data so that we can make informed decisions. Anyway, there's a lot more. I've written a paper on it, which will be available. But I think that it would be very useful that governments who are interested in asking the question as to what is the impact of accessing Chinese development finance versus the traditional World Bank, IDB finance. I think there's a lot that could be done in shedding some light, objectively, not feelings, on what is good and what is bad. I think there are many who would argue that the investments from China have been incredibly useful in a very, very difficult time. And there were others who would say that it's disastrous, that it's, the cost. But these are feelings, and I think data should be heard. Thank you.
Thank you so much, Gerard. Osvaldo, please.
First of all, thanks for this kind invitation. Thanks, Juliana. And listening, Victoria, I think that the real eminence here are you. Well, from my former post of official of my country, I had the habit to write my intervention, probably in order to avoid misunderstanding. First, some recent trends on trade, mainly trade, between China and Latin America, and at the end, or in the second round, my overall opinion about challenges and opportunity. Well, China has overtaken the United States to become the top trading partner for South America, and the second almost everywhere else in Latin America. Annual goods trade between China and Latin America rose to $445 billion in 2021, up from only 12 billion in 2000. Projections indicate that this trade will be around 700 billion by 2035. China is a big source of financing for the region. Between 2005 and 2021, Chinese state-owned banks loaned 139 billion to Latin American governments, mainly billions of dollars in the region in energy and mining. Some 21 countries in Latin America and the Caribbean have signed up to China's Belt and Road Initiative. Main features of trade relationships. First, China is an increasingly relevant actor in the region's foreign trade. In the aggregate last year, China was the most important trading partner of South America. It was the first trade partner for Argentina, Bolivia, Brazil, Chile, Cuba, Paraguay, Peru, Uruguay, and Venezuela. It was the second for the rest. The share of imports coming from China also varies greatly across Latin America and the Caribbean. The markets in which they are most significant are Paraguay, Peru, Chile, Brazil, and Argentina. In the Caribbean, Dominica, St. Vincent and the Grenadines, and Barbados. Second feature, asymmetry between high levels of trade and low levels of investment. It's true that investment flows have been increasing in the last year, but they are still well below commercial levels. The bulk of the investment flows go to natural resources, although in the last 5 years, they have also focused on agriculture, electrical energy, and transportation. Third, future asymmetry between South America and Mexico, Central America performances. For Mexico and Central America, Chinese manufacturers are a problem not only in the domestic market, but also in the American market, because Chinese products are replacing or challenging Mexican and Central American products. In South America, we have at least two situations. First, countries such as Bolivia, Colombia, Chile, Peru, that basically export minerals, and second, others like Argentina, Ecuador, Bolivia, and Brazil that export agricultural products. With the first group of countries, there is more trade complementarity than conflict. By the other side, manufacturers, Chinese, generate problems in bigger countries with an important domestic manufacturer like Brazil, Mexico, and Argentina. China has FTAs with Chile, Costa Rica, and Peru. Ecuador and China concluded negotiation for FTA in last December, while Uruguay announced the conclusion of the feasibility study for FTA in July 2022. Fourth, Latin America and Caribbean and almost all LAC countries run a deficit with China. Last year, LAC trade with China once again rose to record levels, and the LAC trade deficit with China last year reaches a record high for the second year in a row at 1.4% of regional GDP. The region's trade deficit with China is driven basically by the growing deficit maintained by Mexico and Central America. The Caribbean also runs a persistent deficit with China, while South America has a broadly balanced trade account. LAC nations with trade surpluses with China include Chile, Peru, and Brazil. In all cases, these surpluses are generated by sale of a small number of commodities. The wide gaps that remain in bilateral trade cannot be ignored. This trade is almost exclusively inter-industry, involving the chain of manufactured goods for raw materials. 5, few products explain the majority of products. LAC's export to China show a much smaller number of products exported to China than to other regions and countries. The 5 leading export products of all countries in the region, except Mexico, accounted for 70% or more of the total value export to China, mainly natural resources, low technology content in primary commodities. Mexico, Brazil, and Costa Rica show some intra-industry trade with China and Asia Pacific. Also, the region has benefited in various ways from the growth of its sales to China. The composition of the export baskets remain a cause for concern. LAC's exports are strongly concentrated by countries and by product. By countries, Argentina, Brazil, Chile, Mexico, and Peru account for more than 80% of LAC exports. And by products, copper, iron, petroleum, and soybeans account for more than 50% of LAC export. Taking into account the high intensity in extractive industry products, Latin America's export to China create relatively fewer jobs and generate a greater environmental impact than the region export to the rest of the world. So This export structure oriented to China tends to be more polluting than that oriented to the rest of the world. The region faces then a growing challenge to move towards a more diversified, knowledge-intensive, and socially and environmentally sustainable productive and export structure. In this context, export diversification is an urgent challenge. In this way, I have 2 or 3 minutes. From this point of view, the real challenge in trade and investment relationship is only part of the story. Why? Because, by the way, the relationship must contribute to progress on traditional challenges, high sustained growth, reduce poverty, reduce extreme inequalities, diversification in production and export, advance on innovation, productivity, and generate quality jobs. So this relationship must contribute to progress on the challenge, such as the relationship with the US and the European Union. The numbers say that trade with China contribute to green goals and employment less than trade with other areas. But the problem is not China, but it's our problem. We are the ones who have to promote productive transformation, growth with equity and in a sustainable way. We are exporting commodities with low level of elaboration or technological know-how, and we need a productive and export matrix more diversified, with greater knowledge content and greater links between modern and backward companies. No one is going to do that for us. Neither China nor USA, nobody, only us. If there are security concerns about Chinese investment in some areas, the task is to raise security standard for any FDI, wherever it comes from. The same with labor, environmental, or competition regulation. What cannot be accepted is that some officials question Chinese investment in a port in Peru or in an electric train in Chile without presenting alternatives. Criticism is easy, but providing financing and technology is more useful for Latin American countries. Thank you.
Thank you so much, Osvaldo. So before we move to Q&A, I just wanted to maybe sum up some of the so important and challenging reflections that Hannah, Victoria, and Gerard and Osvaldo shared with us. First of all, that of course there are significant differences between countries in each region, and broad regional comparisons may not reflect their individual situations. That means that each country has its own dynamics, as Hannah and Victoria mentioned. So we should just consider that when we try to compare and to look at both regions in particular and in a comparative way. Of course, one thing that all the experts in these panels highlighted is how these countries, both in Latin America and Africa, are going to deal with China, but also with other partners. Not only regarding, of course, climate change and how to address the impact of investments and finance from these countries, but also regarding how to add value to their exports, how to promote industrialization, And just to sum up, as Osvaldo said, and also Gerard mentioned this, that this is our duty, or I mean, Latin American countries and also African countries should just think about how they are going to negotiate, how they are going to deal with the problem, with this problem that is ours, that is accepting like what types of finance are we going to accept, how are we going to promote development in our countries. This is more an issue that we should discuss in our regions in particular, and also maybe between our learning from each other, right? From African countries and Latin American countries. Now I just want to open to question, comments from the audience and also from people that are connected. Yes, Evan.
Thanks. Evan Ellis, U.S. Army War College Strategic Studies Institute. First of all, a fantastic panel. Congratulations for the input. There's so many things that we could talk about. I really want to focus my question on Hannah, given the three excellent Latin American and Caribbean insights. I want to center on a couple possible sources of comparison. And again, this will be probably more questions than you can answer, but I just wanted to ask from an African perspective, 6 things. Number one, do you see the same expansion in electricity infrastructure, especially green energy, and also IT infrastructure in Africa, that shift away from commodities that we see in Latin America? Number two, do you see in the smaller African states the same difficulties in regulating the number of Chinese employees that are brought in, as we see in the Caribbean? Number three, do you see in Africa some of the issues with China's use of state level or subnational level, and especially sister city relationships, as a way of circumventing national policies? Number four, like with SELAC, do you see in FOCAC the use of committees as working vehicles for advancing Chinese projects? 5, do you see, like in Latin America, that it is the middle income countries and not the big commodity producers that often get the most Chinese actual investment as opposed to loans? And then finally, do you see China's interest in using free trade agreements in Africa as a vehicle for opening markets like we see in Latin America with Chile, Peru, Costa Rica, Ecuador, Nicaragua, Honduras, El Salvador, etc.? Forgive so many questions, but I just wanted to raise these excellent points of comparison, and congratulations.
Thank you, and I'm gonna collect 2 more questions and just leave the experts to answer. Mark?
Hi, Dave Schulman from the
Sorry.
Atlantic Council. That's okay. I just have one question. I can't compete with Evan's. Thank you. It was a great panel, great comments, and really insightful. My question, I think, mostly relates to what Gerard was saying about China's role in renegotiating debt, whether it's in Latin America or Africa or elsewhere, and that's a big focus right now, obviously, as so many countries that have had economic engagement with China over the last many years have found themselves in deep debt and trying to deal with that, especially after the effects of the pandemic. And as you mentioned, Gerard, I think this issue of whether or not China will be a free rider or actually be a part of some of these collective efforts to renegotiate debt, right? And those questions I think are really critical. In the last few months, we saw China finally coming around to renegotiate its debt with Zambia, which I think was around $6 billion or so. And the question that a lot of people are asking are, okay, is this a model for what can be done in other countries across the developing world where China has a relationship with a country that's in significant debt to it? And so I guess my question for you, Gerard, or also others who want to jump in is, do you see what transpired in that renegotiation with Zambia as some sort of model? Is it unique to that relationship? Could it apply in Latin America, Suriname, and other places that are in debt to China? Thanks.
Thank you very much. This is Elijah Muni from Kenya, USIU. My question, two questions. One is a comment to Gerard, because I feel like what he said about the experiences of countries with regard to tied aid is what now people feel about Chinese aid in places like Kenya. Sometimes we make a joke of why do we need a Department of Engineering for civil engineering, because all the roads are being made by the Chinese, and it's not just in the capital, it's deep inside. So it's interesting that you said the tied aid bit has been traditionally a problem with regards to American or IMF or World Bank, but now it seems to me, from a contrast point of view, that it's become a problem with regard to China as well. Then my second question is to Osvaldo. Sorry if I mispronounce the name, but it's really interesting because the statistics you give about the trade, almost every other country in Latin America, the #1 importer is Chinese. You could say the same for Africa. Most African countries now, more than 20% of their imports are from Chinese, 20% and up. And so my question is with regards also to the question about the FTAs, because one of my frustrations about China is the level of exports to China is actually pretty low compared to the levels of imports. And the question is, for the countries that have had the free trade agreements, the Chile and Costa Rica, sort of where does the idea come from? Is it more a push from those countries, or is it a push from China? Because as I understand, and Hannah can confirm, for now I don't know if we have any country in Africa which has an FTA with China. Thank you.
Thank you so much. We tried to answer to these first 3 questions, and if we have more time, we are going to. I saw some hands up there, but maybe if you can take just 1 or 2 minutes to answer, so we can do more questions. Otherwise, we're running out of time. Hannah, sorry. Okay,
I'm going to find out how to wrap up answers to 6 or 7 questions in one. But let me first quickly, I'm going to do, so in terms of, one, they're very good questions, I should say. Thanks very much. In terms of expansion in electricity infrastructure and digital, there is definitely an expansion in digital, that's for sure. And it is a mix of different models. It's not necessarily just lending, it's also equity. And it is to some degree a shift in foreign direct investment. But I would say that there are still foreign direct investments in natural resources that are going on from China on the African continent. So it's not, this is more kind of additional. In terms of the ability to regulate employment, we did a study a while back, which was looking at the country experience of managing Chinese employees on labor contracts. And what we found was that it's obviously determined by the volume of lending and project delivery, but it's also highly determined by African countries' own labor policies. And so if you look at, let's say, South Africa have got much stronger policies in terms of labor than others. Ethiopia, for example, have also been able to negotiate much more strongly. There's a real case for actually bringing countries together to exchange experience on that and to work together on it, especially smaller countries who might really not kind of know what they can achieve. So I think that it is an important question, and especially important in the context of the fact that a lot of Chinese engagement at the moment is actually to do with African governments procuring projects, not necessarily multilaterals, yes, but it is also a major source of financing for projects is open procurement through national governments. And so that I think is going to be interesting to do more on. Very quickly on state level versus kind of provincial level versus national. It's planned and and expected. So Hunan is a planned engagement. It's really about China, Africa. It's planned at the national level, and it's really about piloting different ways of engagement and prioritizing different. And Zhejiang, for example, has specific agreements and policies which are agreed at the national level, but then agreed as a pilot. So they're not ways of circumventing, but they are ways of trying out new things. So they are important to look at. Committees to advance Chinese projects, we haven't really seen that, especially cross-ministerial ones. There is CIDCA, which is dealing more and more with aid, and that's obviously cross Africa and LAC and so on. And that is doing much more coordination of aid, but there's still much more to do in our view on that. FDI still goes to a whole range of countries, both mixed and licked, and also not just commodity producing. So a lot of the foreign direct investment, South Africa is not just into commodities. There is interest in free trade, but more in terms of preferential agreements. And we've seen preferential trade improve, preferential access for low-income countries, least developing countries, improve over the last 2 years. There have been specific policy measures taken there. There is one African country that has a free trade agreement with China, that's Mauritius. But there's more engagement with the African Continental Free Trade Area, and that's the big kind of question as to how does China and for other development partners, how can they complement what is done at the AFCFTA level in terms of regional integration for trade, while still increasing preferential agreements. And that is just not yet clear from any partner. I think even AGOA has a major issue with regards to that. And finally, on the debt treatment, I will share in the chat at least, but I've just brought out an article, an op-ed about G21. And my view is that, and G21 debt framework, my view is that the Zambia example actually in some ways sets out the failures of the G20 framework, because Zambia could have gone to China previously for debt relief much faster. And that has been the case in the past. So, Zambia's largest debt relief, bilateral debt relief provider in the past. And it's unfortunate that it had to wait for such a long time because of this new process. Some would propose some alternative ways of dealing with that. But nevertheless, I think there's still a real lack of understanding about the debt relief that countries have been able to get from China in the past, and what is the best way of doing that. Our view, again, is really it's about countries working together to understand what the best debt relief they have got from China is and what parameters they've used. But that's for borrowing countries to exchange on that, as opposed to speaking to other creditors doesn't necessarily help with that plan. Thanks.
Thank you, Hannah.
Sorry for taking so much time.
Thank you. We just have 4 minutes, so please sum up whatever you want to say. I don't know, do you want to begin? Yeah.
In 30 seconds, I can speak to the 2 questions. One, is the Zambia precedent good for the Caribbean in terms of the debt restructuring? I think the key question, which I would love to hear some more, maybe over coffee, is what did it happen within the institutional arrangements that exist? In other words, did it respect the Paris Club structure? Was it in partnership with other creditors, or was it a side deal? I think regardless of the terms of the renegotiation of the debt, it's how it happened, I think, that really, really matters. If it's not part of the existing institutional arrangements, because everybody knows what's going on. I mean, the US and Europe run these development institutions, and China's pushing back. So, not participating is one way of doing that. So it'd be very important to know in Zambia, was it within those arrangements or not? With regard to the tied aid, I think the development banks can learn. Tide aid, obviously, it has it always has had its downside, which is that it crowds out local contractors, it crowds out local institutions. But as somebody said, it's the choice of these are grown-up governments who make these choices. I think the development banks, though, could look at it, and as they're trying to do, I think, in Marrakesh, and ask themselves, how can they become more of a Banco Amigo again while holding on to transparency safeguards? Thank you.
Thank you, Gerard.
Well, about the impact of FTA in the case of Chile. Well, Chile is one of the few countries that maintain superavit in trade relationship with China, mainly thanks to the copper. Right now, Chile is orienting about 40–45% of its export to China. It's very, very high level. And about 5 products explains 80% of its export: copper, lithium, salmon, wines, and fruits. The problem is not to export natural resources. The problem is what to do with natural resources. The challenge, the real challenge, is internal, is a challenge of domestic policy in order to create the links between these natural resources with manufacturers or services in high technology oriented sectors. It's not give the back to the natural resource, but to use the natural resource in a strategy of productive and export transformation. For this reason, it's a Chilean challenge. For Chile, it's very useful to export copper, of course, and for the government too, because there is a huge amount of taxes around the region. But of course, in the medium or long term, to export mainly this kind of natural resource shows a large gap between this sector and the technological revolution we are living now. And finally, in terms of the more regional or national challenges, I think the problem is, or the challenge is, a more coordinated regional or sub-regional strategy. That means privilege plurinational approaches in the relationship with China and giving less emphasis to the unilateral approach to China that is more dominant right now. Scale matters. More coverage initiative capable of attacking research in larger scale of initiative. Defining regional priorities or sub-regional priorities in agreed agenda that includes export diversification, attracting Chinese FDI, investing in Asian value chains, and advancing also on trade and investment operation in renminbi, working on joint plurinational approaches 2 or 3 Latin American countries in terms of export diversification, creating synergies in innovation projects, science, tech, business alliances, and so on. I think it's a real challenge. It's not easy, but I think it's the only way to take benefit from the relationship with China. Finally, I underline this is domestic challenge. It's a regional challenge. Thank you.
Thank you, Osvaldo. We ran out of time, so I'll ask you to give a big applause to this wonderful panel. Thank you very much.
You are the winners.